Victor Shwets, head of Asian strategy with Macquarie Securities, joins us from Hong Kong. Victor, good morning. Thank you for joining us. Victor, what do you make of the Fed talk post the FOMC meet? Even ECB is staying put. When do you expect them to start tapering?
My view is that Federal Reserve, if there's going to be any tapering at all, is going to be very limited. It could happen in September, it could happen in December, but it's not that relevant. The key question is, if Federal Reserve really tapers, should other central banks intervene, including ECB, BOE, PBOC? My answer is yes. We're too highly leveraged to have any significant withdrawal of liquidity.
So what does this mean, Victor, for liquidity for Asian equities? Is the liquidity tide now receding?
Yes, the liquidity tide is receding for a number of reasons. One of them is US dollar appreciating. Another one is Japanese yen depreciating. And that causes incredible amount of volatility in currencies as well as in capital flows. So I suspect whether it's banking liquidity, whether it's FDI liquidity, remittances, donors, alternatively portfolio investment, at least for the next 3 to 6 months, liquidity will remain very, very tight and probably decline even more.
Does the currency weakness make you jittery about Asian equities?
All emerging markets, you have to be jittery when US dollar is going up. This is the third time since 1970s when US dollar is starting to appreciate, and every time emerging markets perform very poorly. That's primarily because most emerging markets either fix their currency against US dollar or alternatively they shadow US dollar. So when US dollar is going up, those countries have very uncomfortable choices to make.
Victor, investors have also been losing faith in the ability of emerging markets to restart growth. Do you see developed markets outperforming emerging for the rest of 2013, or do you see scope for a reversal?
In terms of equities market, the answer is no. I don't see a great deal of scope for reversal. I think developed market equities will continue to outperform emerging markets at least for the next 3 to 6 months. Beyond that, it really depends on the speed and pace of global recovery as well as the position of central banks.
As a house, do you still maintain your overweight rating on India? And what do you make of the recent tightening by central bank? Because of the central bank policy action, clearly short-term growth could take a hit.
Yes. Essentially, when liquidity dries up, you don't want to be in a countries operating significant twin deficits, which is what India has. India does not have a stock problem. In other words, India doesn't have a huge amount of debt, but India has a significant flow problem. And they share the same fate with Indonesia, Turkey, and many other countries.
So do you think investors need to reset their growth expectations? Is 5 to 5.5% GDP growth good enough?
I think investors need to reset growth expectations for everyone. There is this underlying assumption that somehow emerging markets needs to grow. I don't see any particular reason why that should be so. So it's not just India at 5.5%. The same applies to Indonesia. The same applies to Thailand. The same applies to China, Brazil, Russia. All emerging markets have to reset their expectations. The only exception to that are emerging markets at a very early stage of evolution, like Sub-Saharan Africa.
In your latest strategy report, you mentioned that India needs to embark on reform. What reforms would make you happy?
Well, India managed to snatch defeat from the jaws of victory for at least the last 50 or 60 years. So the reform list is extremely long. Everything from pricing to land to labor reforms. They are taking very, very few of them. And it has to be a comprehensive reform package. Otherwise, India will not be able to compete for capital.
And what about cyclicals versus defensives? Do you see cyclicals underperforming defensives in Asia?
Well, that's exactly what's happening right now. Defensives outperforming cyclicals, whereas in developed countries, it's the other way around. From my perspective, when I look at right now at the gap between the two, that investors are getting very jittery and too negative in many ways on emerging markets. And I think investors at the same time underestimate the extent of structural challenges that developed markets are facing. So right now, cyclicals are underperforming, but I think the gap between the two might actually narrow.
Do you think the volatility in cyclicals and in general in all asset classes is here to stay?
Absolutely. And there is nothing to say that it will not come back even stronger than it did 3 to 5 years ago.
And has the emerging market run out of tactical and strategic options for investors?
There is always a reason to invest in a market which is beyond the growth expectations. There are relative valuations, there is relative performance, there are overbought, oversold, liquidity. There is a whole range of factors that goes in. So one can never write off any asset class. And in fact, I would argue in the current volatile environment, even the carry trade might actually return back sometime in the next 3 to 6 months. So you can't rule any of the classes out. The only thing you can say is that emerging markets always assume they will grow. There is no explicit assumption why that necessarily should happen.
And finally, do you see a possibility of global economy reviving in 2014 in a significant manner?
When you say reviving, it depends what you mean by that. If you look at global economic growth rates at 2.5%, 3%, that's probably the world can do. If you start looking at the growth rates of 3.5%, 4% or more, I think that's extremely unlikely.
Well, Victor, appreciate your time and thank you for joining us.